So they should have ideally looked and come to their own view. What's the appropriate price earnings multiple? Are these the same size? Do they have a similar financial profile? What about their debt levels? Come up with a view, and then ideally probably, and the thing with this is that they've then, their valuation, they've come up with a number that's higher than the current market price, and they've said that's the controlled premium. All that's more an accident of the way they've done the calculation, because they've used this artificially high profit number, which happens to be about 40% above, 30 or 40% above where it probably should be. So it's more an accident that they've got a valuation that's a bit higher than the current market price. What should have happened, they should have looked down here, found some comparables, and come up with an independent view saying, looking at the above, I think the appropriate multiple would be in the range of, 12 to 13 times or whatever it is. Seems to be, you probably need to understand why Freightways, why they're at sort of a higher multiple than some of these others. Toll's artificially high. Yeah, so it's probably 13 to 14, 12 to 13 times probably is reasonable. Should have had a lower level of future maintainable profit. Looking at the forecast, probably should have been 10. And then you add a control premium on top of that to get to where we think we're going to have to bid. And what they haven't done here is then look at, if we're going to bid here, it's currently trading at that price, we're going to make an offer up there. What do we think? What is this business worth to us? That's its current market capitalisation when we add the synergies and other benefits we can bring to play. And then hopefully we see, we'd be willing to pay, the value to us is $5 a share. We're going to have to pay $3.50. Current market price is $3. So you can start to see, okay, what's the upside for us and our shareholders? Is everyone clear on that? Okay, that's, that'll get you a reasonable mark. If you want extra marks, you would also do a DCF and cross-check that. If you're going to have to do, if you want to get good marks and you quantify your synergies and benefits, which you'd probably also do in the valuation piece. As I said this morning, one line for each synergy and benefit and discount them back to today's value. Then you might as well do the DCF exercise while you're there. Only at a fairly high level. I don't expect you to go out multiple years and do a detailed analysis. Do what most people do with a DCF, have a look 1 or 2 years out. Are there any unusual fluctuations? Any unusual capital expenditure we expect? Factor that in, discount it back, see whether it actually reconciles to the PE-based valuation. Okay, so we've then done, we seem to have done something on the funding here. Ideally, there'd be a bit more wording around what the logic is of why we've decided to do, well, there's a bit here. If it's a friendly bid, we can structure it, we can work together and structure it. I'm not quite sure what they were doing here, sort of, whether this is just the target. Toll has a balance sheet, blah, blah, blah.
It's all right, work out free cash flow.
Yeah, but that's all fine. What I'm more interested in is, I think they've done here, what does the combined group look like? Here's the bidder, here's the target, here's the takeover funding. So they've recognised whether they've taken on additional liabilities. I've tried to work up some ratios for the combined group. So as you can see, I don't normally go through the maths of it in great detail. I just want to see that you've actually given it some thought. I will, if it looks like total nonsense, I will actually start to look and go, wait a minute, what's going on here? Does this make any sense at all? I would have given this a little bit of thought at the time, but I'm encouraged to see that there has been a bit of thought into what the final group look like, how are we funding, how much cash, how much is debt. You can't see that they've actually done. I prefer to see what's the cash position, what's the debt position, what do the earnings look like after the deal's done. So the funding is just a sort of secondary piece to the valuations. And we've got some commentary about what the combined group looks like. We've looked at, there's a little bit on the earnings per share as well, which there's not. And here's some of the post-merger things. So this is a bit fluffy, but a bit soft. They've actually drilled in. Oh, it's not too bad. They've drilled into a bit of it. Ideally, I'd like to see the people in the back